So we are going to be talking about the martingale layering pattern. All right, the martingale's layering pattern. I had to clear my charts, so we are just having an empty chart right now, meaning I still have to stay awake all night to draft out our zones for tomorrow's trade. Okay, for our martingale's layering pattern, I'm going to okay, this is what we use all the time for our entries and our exits in the market. Okay, so this is what we are going to be talking about first thing we are going to be learning today, our martingale's layering pattern. So I want everyone to note, just assume that from here, this was where the call came in. All right, somewhere here, let's assume that we are about to take a sell in the market. Let's assume that we are about to take a sell in the market from somewhere here, and this zone currently is 1933. So I'm going to put my line at this zone, since I feel like this is my zone of interest. All right, that's from my analysis. So the trade I'm going to call a trade, and I'm going to pick from this current zone, which is 19. Always look at this place to see where I'm talking about. All right, which is 1937. This is my zone, so I'm going to pick 30 pips within that zone. So the first thing I'll do is, in order not to miss this entry, I'll pick 5 pips below somewhere here, and then 25 pips above. So if the call is going to come in, I'm going to tell you guys, since currently I'm having 1937.6, so I'm going to tell you guys to start from 1937, which will be okay. So I'll just say XAU USD sell, right? Then I'll draft out my zones, which is 37 to 1940. All right, which is 30 pips above. So I'm having 1940. Okay, then I'm going to pick my SL, and my SL is going to be 50 pips from my first entry. So from 37, 50 pips from 37 is going to be 42. All right, so I'm going to put 1952 here. So my TP1 is going to be 40 pips from my first entry, which is 1937. So 40 pips from my first entry is going to be 1933. All right, so I'm going to write TP1. My TP1 is going to be 1933, right? And my TP2 is going to be 70 pips, 70 to 80 pips, depending on where I have the next structure. Okay, but since this is just for an analysis, we are about to enter a trade, so I'm just trying to draft out something for all of us. So my TP2 might be 1930 or 1927. So this is it. So we have our trade, and now we'll call it in the group. Okay, so this is how our trade comes in. So remember, this is the current zone where the market was. Okay, and this was where I typed stand by, wait for entry. So the market was currently here. I'm going to use an arrow to, okay, I think trend line should do it. This was the current zone where the market was. All right, so now you will wait for the market to get to this zone. Now when I call the trade, you are not just going to enter the trade immediately at 1930 or 1929, sorry. You are going to wait till the market gets to your zone. So when the market gets to your zone, what do? You enter that particular trade. But since this is day trading, then mind you that this market is going to actually take a very very long while to do this, because all this happened in a day. So let's go to the hourly time frame, so it will be easier for everyone to understand. Okay, this is our hourly candle. That's perfect. So even if I'm going to make any adjustments, I might be making my adjustments somewhere here. Okay, let's assume the entry came in somewhere here. So I would like everyone to pay attention. I think we will need to move our text. We need to bring this close. So watch how we make our entries and how we exit the market. Also how we set our BE. So I'm still trying to bring this close. I'm still trying to zoom in so everyone will see what I'm doing. Okay. So currently this is where I'm having multiple tops. 1, 2, 3. So if I'm making any call, I'm definitely picking from these zones, from the analysis. So definitely I'm going to modify this to this our current zone. Alright, I'm going to modify this to our current zone. So we have 1946. So I'm going to change this to 46 to 1949. Alright, and our SL might be 51, right? Our SL should be 51. And let's even still say we are using the same take profits. Okay, let's say we are using the same take profits. So this is where the market was currently before you do anything on this trade. This was where you caught this market. Let's keep zooming in because I want you to get this very very clear. This is where I want you to view the market. This is where the market was currently, around this zone. I'm going to make this slimmer. So this was the current zone of the market. Now you are not just going to enter this trade immediately you see sell. All right, you wait for the market to come to 1946, which is even somewhere close to this zone. So what you do is you open with the smallest lot size. Okay, you open with the smallest lot size. For the sake of explanation, I think we will still need to like expand this chart. We will still need to expand this chart so everybody will be seeing the chart clearly. The most important thing is for you to understand what I'm teaching and what I'm doing. So if I'm even going to draft out a zone here, I'm looking at a shorting position, something like this. Okay, I'm looking at a shorting position, and this was where I have my, this is where I'm taking as my take profits. So if I'm using any place as entry, definitely my SL is somewhere here and my take profit is somewhere here, meaning I'm having a reward ratio of 2.8. If you look here you see it, I'm having a reward ratio of 2.8. So let's use this as instance. So I don't need to actually type out this zone now. I don't need to type out this zone. I've calculated my risk from here to here. All right, from here to here I'm having 100 pips. Okay, from here to here I'm having 100 pips, and from here to somewhere here I'm having times 2.8 of that. So if I'm actually trying to enter any trade, once I call the trade, let's use it as our entry. I'm going to use my horizontal ray. If this was my first entry, always look at this place. That's my first entry now is 1947.16. Now you are not just going to open multiple positions around this zone, something like this and something like this. This is very very wrong. I'm going to zoom in. This is very very wrong. All right, you don't open multiple positions. Now mind you, this is your zone of entry. This red box, all right, is your zone of entry, and your SL is somewhere here. Okay, this is your SL. Now you don't just place your trade like this. Now let's also put this line as our stop loss. This is our stop loss, and this line should be red. Okay, so if this is our stop loss, and now imagine you are risking from here to here is that's this 1957 and this is 1947, which is 100 pips, exact 100 pips. So imagine you are risking 0.1 lot size on this setup. That means you are risking just $100 on this setup. Now imagine you went to open 0.1, 0.1, 0.1. You see that you've lost this trade, because if this trade hits SL, you are not just losing $100, you are losing more than $100. Okay, meanwhile martingale's layering pattern helps you to actually minimize your losses and maximize your profits. So when you want to enter, you should move something like this particular line, move it to this place. So imagine I gave the first zone as 1947, and I gave from 1947 to 1953. All right, from 1947 to 1953. Let's leave the other zones that I've typed out. Now we are trying to break it down, and since the chart is looking very, very clustered, we have to just get the zones here. So the ideal thing is for you to understand what I'm trying to explain. So once you place your first enter here, this is an instant sell. This second line now that I'm moving is going to be a sell limit. All right, so you're going to place another sell limit somewhere here, that's around 1950, and then another sell limit at 1953. Now if you watch what happens, you see that the market spiked up, triggered at 1950, spiked up, but this 1953 did not trigger. Now because this is even because we are having 1953.2 something. So if we move this to exact 1953 somewhere, you see that it triggered. The only way this market won't trigger is if your spread didn't touch this line. All right, if your spread didn't touch this line. Now you see that when the market touched this line, it started dropping. Okay, so what could have happened if you were using 0.1 here? You could have been losing a lot when the market was already somewhere here, right? Because this is already 1953. From 47, you're already losing 60 pips, which is $60. Okay, so how do you maximize your profits? I'm risking 0.1 lot size. All right, the only thing I have that I can afford to lose on this particular trade now is $100. I'm going to show you how I break that $100 down. The first position here, I am going to open it with my smallest lot size for the day. Now my smallest lot size is going to be 0.01. all right, so I'm opening this particular position with 0.01. And now you see that this market, even when this market spikes up to this zone, as at this zone already, I'm only losing $30, 30 pips, which is just $3. All right, I'm having a negative of just $3 as at this zone. Now when this zone triggers, when I placed a sell limit here, I placed my sell limit with 0. Sorry, I meant to use text. I placed my sell limit with 0.3, 0.03. all right, 0.03. So this is the sell limit with 0.03. So when this sell limit triggers and this market still spikes up to this place, now from 0.101 to 0.03, that means I've already risked 0.04 total. So I'm still having 0.06 left. So I'm going to open my last position. I'm going to place a sell limit here with 0.06. all right, so if I open my last position with 0.06, now we are going to calculate our losses first for this trade, and you will find out that we are not even losing the $100 that we actually stipulated to lose. Now we've already placed a trade. All the trades we placed, now if we calculate the lot size, we are having 0.1, which is our normal risk. Now someone that just placed 0.1 somewhere here, someone that just placed 0.1 directly somewhere here, let's assume that this trade takes a wrong turn somewhere here. Let's assume that this trade actually hits this place. This person already lost $100, right? Now let's calculate for this particular one. From 0.1 to this zone, which is 100 pips, we already having a negative of $10. All right, we are only losing $10 from this first entry. Now from the second entry, from here to this place, which is from 50 to 57, that's 70 pips. Okay, that's 70 pips. And for 70 pips, what we are going to be losing is, mind you, for every 10 pips we are making $3. All right, so we are only losing $21. So from here to here is 10, from here to here is 21. All right, so 10 plus 21 is $31. So from this last position to this zone, from this last position to this zone, that's from 53 to 57, that we are having just 40 pips. All right, and for every 10 pips we are losing $6. So for 40 pips we are losing $24. Okay, we are losing $24. So someone run the calculation. $24 minus $31, that's around $55, right? Am I communicating?
Yes, sir.
Okay, that's around $55. That's 24 plus 31, that's around 55. Now, did you see that you did not even risk up to $100? Your initial plan was to risk $100 for this trade, but now you did not risk up to $100. Now I want to show you something. Let's now assume that your reward to risk ratio was also 100 pips. Since you are risking 100 pips, now you felt like, okay, you just want 1:1, you don't want to over leverage anything the market brings your way, no problem. Now your first take profit, your take profit for the day is also 100 pips. Now from 1946, the next 100 pips should be 1936, right? Somewhere here, 1936, somewhere here. Now I want us to calculate the profit we made on this trade. That's assuming that this market hits our take profits. Okay, so from this entry to this zone, from here to here, we are going to be having, sorry, our first entry is 1947, so our second entry should be 1937. That's our take profit, 1937. So from here to here is already 100 pips, right? So from this zone to this zone we are making $10. From this zone to this zone we are making, from here to here is 100, then 100 plus this, that's around 130 pips. All right, so that means 13 times 3, that means we are making $39 off this particular zone. So 39 plus 10, that's 49. All right, that's 49. Then for this last zone, now for this last zone, that means when the market drops from here to here, that's around 150 pips. So 15 times 6, 15 times 6 is around $90. Okay, so imagine 90 plus 36, that's the total of what we had. That means we are having $126. Now did you see that you were risking like just $55 to make 120 something dollars? That is for reward ratio of 1:1. So when you martingale, you don't have problem with your risk management, because you already know that inside your risk management you're also managing your risk again, even with your risk management plan. So you are hedging the market with also the market's fund. Now imagine that the market drops from this particular zone to somewhere here. I always tell you guys in the signal group, secure first entry. Now you closed this first entry when you are seeing 30 pips in profit, closed this second one, now you held this one with break even somewhere here. Now the market does this, comes to this zone, breaks out of this zone. Now this was the zone we had somewhere here, breaks out, retest and drops down. Now immediately you see the drop, what do? You open another entry. All right, Immediately you see this retest, you open another entry, another sell entry. Now when you open it, you allow it to run, bring your BE to this position. Now you keep swinging, 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 and you are in more profit. Now that means you only risked $56 for this trade, and you might end up closing this trade with like 200 and something dollars or 300 and something dollars. What I explained, does it make sense to anyone here?
Yes, sir.
Yes, sir.
If you understood what I just explained, can you comment sense in the comment box? Now this is how to use, okay, that's great. This is how to use your martingale's layering pattern. For some of us, we have been holding a sell I called since last week Monday. If you see my chart, I've just been opening. Now for our break even, some of us here, like our break even, we and break even is like we are married. The market always takes our break even before any significant move plays out, right? Now when I called the sell today, let's go to today's trade, since we already understood our martingale layering pattern. Let's look at today's trade. Now this was just today, this was all we had today. All right, this was all we had today. Now if we had zones here to trade, we had this zone, I picked this bottom, right? I also picked this bottom somewhere here, right? Now mind you that a previous low is going to become a present high. That's literally forex trading for you. So anytime I draft out a zone, what I do is I represent that zone with a rectangle, okay, to make it easier for me to spot whenever the market is around that zone. So I have this and I have this. This was the last call we made tonight. All right, this was the last call and I'm still holding. Why? Because I still expect that the market comes to this zone 1817. All right, I expect that the market comes to 1817. Now when do you set your break even? When do you hold? When do you leave the market entirely? When do you hold? When do you leave the market entirely? If you look from beginning of the morning, you see that we had a short uptrend, all right, but it was kind of showing like a retracement. Now anytime the market got to this zone, it bounces off. So when I even called the sell for this particular news, when I called the sell, I cut the whole pips, all right, because I knew that once this market got to this place, it did another little adjustment, but there was a pullback. I had to close. I could have called the buy, but everything was very fast, still spiked before dropping again. But the most important thing was we were able to catch the major moves of the market. So when you are trading, you already have your direction. Like for tomorrow now, when the market breaks out from this particular trend line, if the market breaks out from this particular trend line, we are expecting a longer sell. All right, all my bias is already on the sell. I'm not looking for buying opportunities. That's why when I'm focused on selling, I only trade sells. When I'm focused on buying, I make sure that buying is a solid retracement. That was why we took this buy in the morning and we were able to catch that 100 pips. For those that took the buy in the morning, we were able to catch 80 to 90 pips. All right, so how do we know when to break even? Now you are in a trade and let's say this was where you took the sell, somewhere here. What you do, the first thing you do is you go to your 15 minutes time frame, you check the pattern that is forming there. All right, now you place the trade here. Now you see that the trade starts dropping. Now from your entry, this from 1828 to 1824, that's 40 pips. All right, so once you see 40 pips already, you look at the closest stop that you had to that zone, because this is where also the scalpers and those that scalp, big accounts that scalp, they don't last. They only look for 5 pips, 10 pips, 20 pips in the market. They don't really have any business with your 100 pips, 240 pips. No, because they know that I'm trading with $2 million, right? And I'm risking 500 lot size. You think I have any business with chasing the market or looking for big movements? No. They are okay with, you see this retraction that happened here. Once they catch this week, right? Once the market gets here, they will set their break even. If the market does any other thing, no problem. But once they set their break even, if the market does any further move like below this, they will close, because already they are already like in profit, closing with like $8,000, $12,000, because they know that their accounts can carry it. Okay, so what you do is, once you place trade, you go to your 15 minutes, mark out, you see this high that we are seeing here that was acting as a resistance earlier. This was the high that was acting as a resistance earlier, when the market actually, this was a BOS, right? The market broke this structure, retested, even with the whole spike, still closed in this zone, came back to this zone to verify that it's solid. There was a quick spike, that's this slim wick you are seeing here, but the market still continued with the downtrend. All right, meaning that this zone was very valid. Cool. Now when we called the buy, you will notice that this market actually broke this zone again. This was also a break of structure somewhere here. So anything that will make you sell, anything that will make you to catch this sell, that because of this area that the market have not filled, anything that will make you to catch this sell, definitely you also expect that there will be a trend reversal somewhere here. Assuming this trade closed in this zone, then you can still keep holding. So immediately the market taps here and the market tries to retract back, what you do is either you close all or you hold with a tight BE. All right, you hold with a tight break even. So once you hold with a tight break even, if the market hits your break even, what do? You wait for the next entry. So now you notice that when the market got to this zone, bounced up, got to this zone, bounced up, got to this zone, bounced up, came back to our zone of interest, we picked our sell again. All right, we picked our sell. Now what the market did was the market came back to this zone. All right, now when the market broke into this zone, we could have set our break even somewhere here. That's why break even always saves you. So watch this spike that happened. All right, watch this spike that happened. When this spike happened, the market was trying to get to our zone of interest. Okay, the market was trying to get to our zone of interest. Now when the market got to this zone, now the good thing about psychological level is the market always respects a psychological level. If you look, since you are a day trader, you should also be able to spot out opportunities in the market, no matter how little that opportunity seems. If you look here, you see that we have a high here. Somewhere here we had a low. Okay, for you it might not be significant, but for the market this zone is significant to this zone. All right, so we had a zone here, we had a zone here, so we could have actually been able to spot out this zone. Why? Because if you look at this zone, you see that this zone served as a support for these 3 weeks. Okay, so if I'm actually going to even spot out this zone, now I'm already having another zone somewhere here to trade. So when I see this spike happening, what do? I wait for rejection. I wait to see where the rejection will happen. And how do I spot out those rejections? I use my 5 minutes time frame. How do I spot out the rejections? I use my 5 minutes time frame. All right, now you see that after this spike happened, immediately the market got to this zone, the market dropped back. Okay, so immediately I saw this, I'll just wait for the next entry. This is a confirmation that I'm looking at. So when I see this confirmation and I see that this market was bullish, but now it's closed with a hanging man, this was where I made the call. I will not make the call here. Okay, if you make the call here, you might be able to make a mistake now, but somewhere here, because this zone have been solid since. Okay, but you are going to be able to spot out this zone using the 5 minute time frame. Now when you make the call, you see that this market started dropping. I think this was the news that dropped around 3 o'clock, right? Now this market started dropping, broke our structure, kept dropping. All right. So what you do is immediately you've seen that this market already broke this particular structure, kept dropping down to this place. That's why you have your move your stop loss that is somewhere here to this particular place. This is where you hold with your stop loss. So you hold at this zone with your stop loss. That's your break even. So watch, see this immediate spike that happened. So immediately the spike happened, what do? You hold your trade. All right, so the trade, the spike is going to take you out at break even. So you wait for the next entry. What did the market do? The market go back to our zone and the market started selling immediately. This was when I asked who caught that re-entry. All right, so if you have this prior knowledge, you won't be waiting for all calls. Okay, because at some point you already know that yes, this is the direction we are looking at, and I think this market is respecting this particular zone. That's why I always say we trade what the market is doing, not what we know. All right, because if you go by what you know, you might be making mistakes most times, but you already know that the market is respecting a particular zone. The market have respected it before, so there is still high probability that the market will still respect this zone. Besides, that was on our psychological level, so definitely it's going to happen. Another thing is you also see that when the market opened 45 minutes, there was no wick. So definitely the market will still come back to that zone and do whatever it wants to do, but there is still going to be a drop. And when this market came to this zone, this market still kept on, still closed within this zone. And there was our BE here, and this market still dropped down to this zone. Now watch, there was a rejection. This market came back into this zone and this candle closed here. Definitely that means the market still took us out at BE here. But if you know that the market have been respecting this zone from way back, you should be able to close immediately the market got to this zone, or you will now hold just your top positions. So why do we call it top positions? This is your entry 1829, your next entry should be 1830, 31. If you remember, our stop loss was 1832. All right, and I told you guys before this happened that there was a sell wave coming in. This was when I mentioned this. There was a sell wave coming in, and this sell happened before this happened. All right, this sell happened before this happened. Now back to this last main call. When the market got to this zone, that's the last trade that we called. Our last trade was on, I'm coming, I need to look it up. Our last trade was from 1831, somewhere here, right, to 1835, because I was expecting that the market is still going to do anything, whatever, in this zone. So some persons caught it like the instant sell. Some I caught it from here. I sold twice, sold here too, then sold here. Now you see that the market kept on going down. Now the first place I set my break even was here. This was where my break even was, because I know that okay, this market, definitely if this market touches my break even, that means this trade is not really for me. Then I'll wait for another entry and enter again. So this market drops, broke into this zone, all right, comes back to retest this zone. That shows validation, a strong validation that yes, I can now move my break even to this zone. Now this market drops. What did I do? I moved my break even from here to here. So you don't just move your break even blindly, all right, you move your break even with reasons. When the market breaks a structure, retest that structure, keeps going your direction, that means the market have already retested this zone, so definitely the market is still going to go and test the next lower zone. So what happens? This market drops down, bounces back up. Now if you notice, it did not come back to our red zone. All right, this market just with a little wick, the market kept on dropping. Now the market is, if you notice, if you look at this market with a shorter time frame, you see that there is a pattern forming here. All right, so now this is also a solid entry for those some other persons that will still want to trade this breakout, because what they will now be looking out for is what they will not be looking out for is a breakout, which is almost happening, but on a higher time frame. Then they will wait for the retest. They will enter at the retest of this breakout, and they will now wait for the sell. All right, this is what they will be looking at. This is what they will be looking for. So we already have a pattern forming in this particular market. Okay, so what I'll just do is to keep holding. Since this market have already, it's showing signs that okay, definitely it might still break this zone, I'll just keep holding. So when the market breaks this zone and drops down, what do? I'll wait at this peak again. If you look at it, somewhere I had a flat bottom, somewhere I had a flat bottom. So what I do is I still get my line somewhere here. So when the market actually breaks this zone, what do we mean? When market drops down, right, breaks this zone, retests somewhere here, and drops again, that is when I am going to move my break even that it's here to somewhere here. Why? Because the market already broke this zone and retested here before dropping. Now after this drop have happened, what do I do again? I will still wait. All right, you keep waiting because the market keeps giving. All right, the market takes and the market gives too. So since the market have also broken this zone, what do? I will wait for a retracement, and if that retracement retests here with a rejection that the market is going to drop, I will look for my next support, and I'm going to move my break even from somewhere here to somewhere here. All right, so I'll keep taking the ride, meaning from just a trade that I've taken, depending on the number of days it will take, I can be able to catch the whole sell that will happen for that particular trade. And mind you, when I see multiple rejections, I can also trade the retracements. What I just explained made sense. Can you react with your favorite emoji in the comment box? Okay, that's great. That's great. So this is it. We've already treated the martingale's layering pattern. Now we've also treated how to set our break even. So next time, I don't expect anyone in my community to be setting their break even blindly. I also expect when I say who is holding, I should get some strong diamond holders, right? I should be expecting some strong diamond holders. So on to the next one. The next thing I explained, the next thing I said I was going to show you guys was how to know when to still hold your trade. All right, I was with John Bosco on Sunday, and I explained everything to him. It's quite simple. Okay, find the zone of value where the buyers are coming in. Find the particular direction where you feel like the big banks are coming in. Now you don't look at it with 5 minute time frame. You go to higher time frames like 1 hour. 1 hour should be your list. Okay, 1 hour should be your list. Now look at this current market. From what you can see in this market, you agree with me that our liquidity, our area of demand and supply is on the sell side, right? Am I right or wrong? I need communication.
Yes.
Okay, who
Very
is
right,
that?
sir.
Who is speaking?
Yeah.
Okay, Kudus, can you tell us the reason why you feel like okay, what do you see on the charts? Do you feel like there is more demand than supply, or there is more supply than demand? Okay, when we talk about the demand and supply zone, which is what we'll be treating next on our next topic, I just want to give everyone hints on what to expect. All right, if you look at all this trade now, you notice that the green candles, they hardly pile up. What do I mean? look at this. Okay, look at this, something like this. All right, now do you see how our buy happened? This, that means it's taking longer time before you catch a very very good buy. Now I want everybody to pay attention at this zone so you can see how many pips that we were able to count. Now, which means from here to somewhere here. All right, that's from 1875 to 1889. That's around 120 pips. Okay, that's around 120 pips. Now, before the market starts doing this, but now if you look at the sell pattern, you see that this was a sell, a little buy, a long sell. There was a pile up, all right, for buyers. A little sell came in, small pile up for buyers, a long sell came in. There was a consolidation that was not really going anywhere because this consolidation happened from 1917 to 1913, which is around 40 pips. All right, now after that, what happened? This was a long sell, this just 10 pips. All right, 10 pips different before another long sell. Now there was a consolidation from 1878 to 1876, okay, to somewhere here before another sell, before we have something like this where we had like a major serious buy from 1863 to 1873, somewhere here before we have our next major sell. So just looking at this particular pattern, what does that tell you? That shows you that the big banks actually come in to sell. Like most of them, they trade the rejections of the market. All right, so they wait for the prices to struggle up, then they sell. All right, so in this type of market, without even without the knowledge of trend lines, you should be able to spot out good opportunities to either sell or to either buy. So you will be able to understand your area of supply and your area of demand in the market. So right now, with this type of knowledge, I'm just looking for my selling opportunity. All right, in this type of market, I will be looking for just my selling opportunity. And after a long sell, once there is a retraction, expect another long sell. I just said I'm going to do a quick analysis, right, with you guys. Now I'm seeing a bottom here. This was my lowest low currently that I'm seeing in this chart. From here, from the origin here, I'm having, this is a low, right? This is a low, and this was the lowest low. Okay, now if I'm going to pick this particular zone, I might try to pick somewhere here, and I'll somewhere here, also somewhere here. All right, now if you look at when the long sell happened, see that this market consolidated, dropped down to this zone. When it broke into this zone, there was a retest before the buy started happening. Came back to this zone, went up, came into this zone, slowly broke this zone. I'm going to zoom in so we all pay attention. Broke this zone, retested, closed with a doji. Okay, closed with a doji. But if you go to a lower time frame, you might see that this actually closed with a shooting star. Now before a long sell happened, all right, before a long sell happened. Now this is the juice, right? This is for just beginners trade, beginners. I had a long sell from here to here. Okay, so if I catch my next area of interest, what do? I can as well pick this line from somewhere here. Now did you notice that this market actually moved from here to this line? Exactly what happened here, my longest sell that happened here, did you notice that it actually happened from here to here? which means assuming I was able to catch this sell somewhere here, I will only be looking at modifying my BE till I hit my target. Okay, now I'm still going to move this line. Let's look for the next area where there was pile up in the market. The next area where we had the pile up in the market was here. Okay, was this area and this area somewhere here. Now pay attention. You see that when the market got to this zone started acting as a support, right? This market kept on till there was a breakout here. Look at this red candle. There was a breakout. Now see the retest. The retest actually went very well into the zone, but when it closed as a shooting star, but it's green, so we're not going to call it a shooting star. But the direction of the wick, where the wick was longer, already told us that yes, the sellers are in. Now you see that this market actually sold, had a pile up, came back to this zone to retest this zone. So imagine you missed out on this because you are not sure. This could have served as a trigger for you. All right, this could have served as a trigger. Mind you, we already traded this. Definitely you might want to wait for this or for this. Okay, once this spike happened and the market closed within this zone, that's also a solid entry. So when you catch this solid entry, how do you know when to leave the market? You can still pick this longer sell down to this zone, and this market still dropped down to our zone. Okay, this market still dropped down to our zone. So if we are looking at the market selling again, definitely anything that this pile up gives us from now till Friday will determine the direction of the NFP news that is coming up, or the direction of the PPI news or the CPI news or the core, any of that. Okay, does that make sense? If you know you got value,
Yes, sir.
if you got value for being here, I want you to comment value in the comment box. Okay, that's great. And with all that being said, I know I've done justice to the few topics that we promised to look at today. So we are going to call it a day, and the link to the class will be sent either tonight or tomorrow. And so for those that want to still go over it, and for the latecomers too, you can always go back to watch it, then practice. Please, trading is not one man's business. Always make sure you practice till you fine-tune your strategy. Forex, quote me anyway, is all about rinse and repeats. But you will keep learning. No matter how good you are, you keep learning one thing. The market always has something to teach you. Okay, take your losses as your lens. All right, so that's all for tonight, and our next class is going to be on Saturday or Sunday. I'm going to communicate that with everyone. That's going to be a general class where we'll have the weekly market review and overview of what the next week has for us. And okay, one more thing. I think we will have our live session either on Thursday or Friday, or one of those 2 days. So that will also be communicated with everyone through the broadcast message. So that's it. And now I will be attending to any questions you might have, right? Any question?